Neil Shah, the Sage of Holborn, our very own Director of Research. Are you ready to play the Edison Bull or Bear game?
Ready to go, Elliot.
FTSE 100 to exceed 7,200 by year end.
Bull.
Global technology stocks.
Bull with a caveat.
Inflation over deflation.
Inflation.
Sterling.
Bull.
Fundraisings in 2021.
Bull.
Gold price.
Bull long term, neutral near term.
Bitcoin.
It's a difficult one, that. Bull.
UK commercial property.
Selectively bullish. I think you're going to need to be in the right places.
The Illumina Fund.
Bull. Great track record.
ESG.
Bull.
Sell side equity research.
Bearish. No simple answer to that. I think research is something I believe in. I think it'll evolve.
Watching cricket at Lords this summer.
Oh, now you're talking. Bull.
Good.
The vaccine will have got us there.
Yeah, I hope so. I'm looking forward to getting out, maybe playing and watching a bit of sport. But on the flip side, Neil, we must be saving a fortune on corporate entertaining.
I think so. I mean, we haven't been able to go out, haven't been able to meet people for dinners. Definitely be saving. You're just not doing the trips. Conference trips, things like that. I think a lot of people probably realizing just how much they've saved over the last year as a result of that.
Yeah, for sure. Okay, well, let's delve firstly into equity markets, and the 7,200 figure I mentioned was a UBS prediction at the start of the year. Since then, the markets have rallied pretty hard. They're up as much as 6% in the first week of trading. Equity markets have proven very resilient to the pandemic, uncertainties in the economy, and various lockdown measures. Do you think that this can continue, Neil?
I think so. I mean, I think the sort of bullish arguments are that the fiscal and monetary policies are in place to support it. The UK specifically, you've had Brexit uncertainty removed, and there's quite a lot of outflow of funds in the sort of build up to that, the deal. And I think you'll see those funds sort of return, not immediately, but gradually over time, supporting. I think the vaccine rollout is going to be key, and making sure, seeing it effective. Other things which I think I think the comps are going to get easier as we get into sort of from March onwards. So as companies start to report, you will see growth coming through in corporate earnings. And then, my own personal view, there's pent up demand. And I think that's going to catch the thing that you've got to watch. I do hear the other side of the argument that certain stocks look really, really sort of pushed on valuation. And that there is a risk that you start to see sort of a bubble forming. But I think particularly for the UK, I reckon there's plenty of headroom to get to the kind of numbers and valuations with that kind of upside.
Okay, great. Well, let's touch on those valuations, the other side of the Atlantic. We've got the S&P trading on about 36 times cyclically adjusted price earnings, driven by technology stocks. Do you think that these valuations are sustainable?
So, I mean, I think that, look, the bad answer as to why I think the tech rally is going to continue is that I don't see a shift in this trend that of the growth of passives, and so more and more money is just going to chase the heavy index weights, and that's going to continue. I think the slightly more constructive and positive reason for seeing tech outperforming is that quite a lot of the sort of productivity gain going forward, I think, is going to come through from tech, particularly with the sort of 5G rollout. And you've seen the sort of bidding in the US in terms of what the people are prepared to pay for the auction price. And 4G, I think Dan Ridsdale wrote a piece about just it disappointed, whereas 5G, shows potentially quite a lot of promise. And I think it's got the potential to change a lot of the way we do things. I also think this whole, just the rollout from this whole pandemic has changed a lot of mindsets in terms of technology being an enabler. The shift to the cloud is a first step to allow for, machine learning, AI, and for that to start to come to bear in terms of the way we're going to do things. So long term, I think there's quite a lot of reasons for seeing, tech doing well and being a major contributor to our growth. The risk is that the market gets too far ahead of itself, and then it's a sentiment driven thing, and once you start seeing the selling, it can accelerate pretty quickly. And that's the problem of passive strategies, is that you just buy as things rising, you're buying them at a higher and higher price. Whereas I've learned to buy things cheaply.
Yeah, sure. So potentially more volatility to come.
Yeah, absolutely. I mean, without a doubt, I think because of the sort of question marks around valuation, if you see sentiment slip, you'll see a lot of volatility in the market.
You sort of indicated that you were bullish on inflation over deflation. Are you okay to talk about some of the dynamics there?
Sure, Elliot. I mean, I think let me ask you. Let me ask you this. So I think what you're seeing right now is that corporate profitability has held up reasonably well. I mean, there are certain segments which have been hard hit. If you're running a restaurant, clearly that. But generally speaking, if you're looking at how companies have fared through the pandemic, they've done reasonably well. And there is this huge amount of monetary and fiscal support in the market, and this big QE programs that are sort of taking place, these huge stimulus packages that are being enacted to make sure we get through it. And then, there's some concern that what happens as that starts to get sort of tapering off. And I think one of the things that is probably going to surprise everyone is firstly this idea around sort of pent-up demand, and we saw elements of this over the sort of Christmas shopping period. When you saw the supermarkets reporting, Morrison's reporting, great champagne sales and things like that. So let me ask you, Elliot. Okay, when you mentioned Lord's over the summer, when you can finally get out to a pub, are you going to go?
I certainly am. Yeah. And I think, not only that, but holidays as well. I think, for those that haven't been adversely impacted by the pandemic, then there's probably a bit of disposable income there to sort of celebrate.
Yeah, and I think it's going to be, I think it's been hard. I think it's more broad than that. There's been a lot of people who, you think about, where we are today. My kids, have witnessed a life of lockdown and, the Capitol building being stormed in the US, etc. And, you're thinking this is not normal life, right? And I do think that as we get out of this, there is going to be, quite a lot of pent up demand as people want to just treat themselves, treat their families, do that something a little bit special. The other thing I think that is that the corporates who have taken out, you mentioned corporate entertaining costs have been taken out. Actually, I think a lot of costs have been sort of stripped away through the sort of pandemic, and profitability's held up. And when demand comes back, you're going to see that sort of very leveraged effect coming through as revenues start to pick up, margins will really start to accelerate. And I think that that's going to lead to the longer term sort of price pressures. Broad money supplies up, I think something like 13% in the US. There is definitely signs that inflation is coming down the track, and short of another black swan type event to derail us, I think that we're going to see, quite a lot of pressure coming through on pricing, a year from here. So hence my view is inflation is coming. And I think the stocks, it's one of the reasons I think the equity markets will continue doing well.
Yeah. And I guess as well, gold price, many people see that as a hedge against inflation. And of course, people recognizing that Bitcoin might be a hedge against inflation
Yep,
as well.
absolutely. And I think, I think the gold bugs, it's almost like when you read the sort of commentary, it's like religion. But I do think that long-term sort of perspective there, and read Charlie Gibson's research. I think is well sort of founded around the sort of monetary base and the targets he sort of set. But I do believe that gold will continue to fare well over the next couple of years, mainly because of the where we found ourselves, the policy measures that have taken place, the actions corporates have taken. And I think we're going to get this sort of pent-up demand hit coming through, and that's going to lead to the inflation surge.
And related to equity markets, let's move on to fundraisings for the year ahead. And just as background, the LSE total funds raised through IPOs last year was 9.4 billion. That's a 30% increase year on year from 2019. We also saw a doubling of secondary issuances. What are you hearing at the moment for the year ahead, Neil?
I think there's expectation that that's going to continue, that more and more companies are lining up to access public markets, in part because valuations do look attractive to list, given the support the market has had. But I think there's more, there's more fundamental reasons for it as well. You've seen a major dislocation in the market, a lot of opportunities, and those firms that can capitalize on that to grow market share, to improve their market position, and hence long-term improve their margins, I think will take advantage of that. I also think that there is going to be a little bit of a mindset shift. I mean, I remember, you're aware that my sort of early life in terms of sell-side analyst was at Goldman, and I remember when they moved from partnership to listing as a public company, and it was on the back of the Asian crisis. And when you see a crisis, a lot of people think about fundamentally how their business is structured and where there's their access to capital. And I think that there is a demand effectively to get access to this very wide pool of public, public money effectively. And so I think more and more companies are going to rethink, their strategy in terms of access to capital, and move from relying just on private equity and private capital and banks to accessing the listed markets.
Great. And the Illuminator Fund, unsurprisingly bullish on the Illuminator Fund. As a bit of background, FT article recently, the fund has returned 1,170% compared to the FTSE All Share gain of 89%. That's since inception in 2008. Do I give you my money now, Neil?
So let me give you a little bit of background around the Illuminator. It's a screening tool. It's a screening tool that we set up at Edison, fairly early on when I sort of started running the research department. And it's based off a very simple hypothesis that I can't tell you whether one tech stock is better than another or one biotech stock is better than another, but I can tell you the attributes of a good quality company, and they're all the things that you look for: recurring demand patterns, well-structured balance sheet, right out volatility, above GDP, earnings growth, decent profitability and ROI. And we've constructed effectively a series of measures that we screen the market for. We've been publishing this for now, I think, over 10 years. And it has it picks 10 stocks. rotation is relatively low. I mean, so typically one stock a month drops out and one comes in, and it's had some amazing performance in that time. But that's because you're picking good quality companies, and those tend to outperform anyway. So last year, so 2019, I think it delivered close to 100% return. Last year, which was more challenging, it delivered, I think, 29%, when the FTSE 100 was down 15%. So it's got a very, very good track record. I think the only time it tends to underperform is when there's a sort of a dash to trash. But it over time, it seems to sort of pick winners quite early on, and then see the returns coming through from that. We used to make this available to our institutional clients, and then with MiFID II, but we moved our model to a pure corporate funded model. With the Illuminator, we have given it exclusive access to a direct to consumer fund, who is in the process of launching it. So Thameside Markets will launch hopefully in February with a strategy which includes the fund, and so that's how you can access the fund, hopefully from sort of next month.
Great, that sounds exciting. I imagine the portfolio turnover is fairly high, but that's great to hear that we might be able to access it.
Yeah, I mean it's relatively it's well tested, and you typically have sort of one name drop out a month and another name coming in, so it's not too high turnover. You tend to find winners sticking it out for a number of years.
Excellent. Okay, brilliant. And moving on to a topic that I guess I get asked a lot from people outside the industry, and not many people give me definite opinion within the industry. You're a bull on Bitcoin. Much talk of it either being a bubble or it might replace the dollar as a new global reserve currency. Where do you sit on that debate?
So I mean, the reason I'm sort of a caveated bull around it is that we've done some work on blockchain last year, and I think had access to some amazing people. I mean, people at Microsoft, people within exchanges, people within the banking industry, within the asset management industry, and the leading lights, leading companies are all finding working on projects effectively to bring blockchain to fruition. So I think if there's acceptance around blockchain, then I think that the currencies that work off it start to become slightly more mainstream. The thing about Bitcoin is that it's the scarcity value around it. So 21 million Bitcoins made. There's not going to be any more. I think I heard reports that around 3 million of these have been lost. So these are guys who bought them very early on, when they were sort of 2 cents, 10 cents, and just lost the passwords, etc. So it's probably, the estimate is that there's 18 million. I don't remember. You probably remember. I don't know if you saw the story in, I think it was 2013, of the guy in Wales who was sort of going through a landfill site because he ditched his hard drive and there was $7 million worth in it. I mean, that was, I dread to think what that's worth today. It's probably $70 million today.
Yeah, an expensive
yeah,
to the dump.
exactly. So I think it's the scarcity value that's of interest, and the fact that the underlying technology is going to gain acceptance, and if you get confidence in the ledger technology and the wallet system, then I think that it could potentially become a store of value. And you are seeing central banks. I don't see any change to the sort of QE that's going to happen. So it's the reasons people are looking for alternatives, Bitcoin being one of them, gold being another.
Yeah, and a number of institutions allocating a portion of their portfolio towards Bitcoin. I believe JP Morgan came out and said that they could see it being similar to sort of emergence as a digital gold and could lift the price to $146,000. And I guess it's going to be a volatile asset class.
It will, and I think that because it's emerging, there'll be some horror stories around it as well. So the thing that will make it, I think, gain general acceptance is for it to be worth something, people have got to have confidence effectively in their ability to invest in it, for their money to be secure and for them to be able to access that money when they require it. And that's, I think, what's going to be tested. And there have been some scandals around sort of Bitcoin over the last sort of 5-6 years, but the more institutional it gets, the more mainstream it gets, the more confidence it builds. That's why it's got the potential to become a rival to gold, and driven by its scarcity value.
Yeah. Okay. Well, moving on to another, I guess, growing trend, if you will. You're a bull on ESG, and we published our first ESG Edge report before Christmas. But what advice would you give to corporates that are looking to better communicate and enhance their ESG credentials?
So I'd probably break it down into sort of 3 areas. The starting point is understanding that the way people assess your performance on ESG is and the way we've sort of developed our methodology is on 2 things. It's firstly awareness, which is all around disclosure, and then secondly around performance. And I think that the starting point is, if you want to succeed in attracting this sort of growing pool of money that is, it's almost embedded in every investment decision now. You will be asked the question, so you need to start taking it seriously. And there's more legislation and taxonomy changes coming downstream, which will make it more and more mainstream. So starting point is find out where you are coming up on the sort of the disclosure point. Raise the awareness in terms of who you are, what you're doing on the ESG, and that's where our research starts effectively. And then we tend to benchmark that against a number of sort of near peers to see how they're doing from a sort of performance perspective. So that's and this old theory of if you measure you can improve, if you measure and report you improve exponentially. And I think that's it's a great starting point, because that simple act of taking it seriously, raising the awareness, will lead to an improvement in performance on your ESG ratings. So that's the starting point. And our ESG product goes through exactly that exercise. So anyone who's sort of struggling to navigate that area, come and talk to us. We can help you with that. The second is to understand that it's dynamic. So just because you've done it once, it doesn't mean you're done. Every quarter, a different topic gets focus, and whether it's the changes because of what you saw from sort of Black Lives Matters and diversity, or how you're treating your employees through the pandemic. Every quarter, the emphasis is always sort of changing, and so it's something which you need to sort of embed into the way you do things, in the way you report on things, and also continue to sort of change the emphasis based on where in the world we are today. And then the third thing is to start understanding how the investor universe is constructed based on where you are. So there will be certain funds based on either industry or your board makeup or your pay policy, where it's just not worth your while sort of targeting them, because you will not get through the door, or you won't get through the sort of screening process. And so getting a proper understanding of the investor map is probably the final thing I'd encourage corporates to do. And again, we can help on that side as well.
Great. Okay, and last topic I'd like to discuss, and it wouldn't be a discussion with yourself complete without concluding on the outlook for equity research. I guess both sell side and independents. How do you see the landscape?
So I mean, I think firstly, I think more and more companies are going to come to market, and there's going to be a demand for information on those companies. I think that the market, look, like last year, last year was good for equity research departments in that the fundraisings and the sort of IPO markets would have sort of supported those departments. I think we'll see something like that this year. But if you look at the sort of underlying sort of component of MiFID II budgets, effectively research budgets, they are under enormous pressure, and I don't think that is going to change. So research departments, will continually have to sort of think about reinventing themselves to be relevant. And our business model is completely different as a result of that to the sort of traditional sell side, and we have fared well through that. If you're going down the sort of traditional sort of sell side route, that you can do some innovative things to help make you different. And the thing that a lot of research departments are focusing on is alternative data to allow them to provide unique insights to the investment community. Now, not everyone is going to be able to do that, so I think the market will continue evolving. I think there's going to be winners and losers. I think you continue to see sort of polarization, and the place where I think there's going to be probably the biggest hurt is in the middle market. So the bulge bracket, I think, will do fine, and the sort of niche smaller players will do fine, but it's that sort of middle area where there's going to be more and more sort of pressure effectively on research departments. But there's alternatives, and so I think research analysts should take heart in that everyone always values a good view on either a theme or a particular stock, and there's mileage in that, and I think you just need to find the right kind of platform to make sure that you're being rewarded for that.
Okay, great. Well, thanks for your insights, Neil. You'll be glad to hear that's the end of my interrogation. Thanks for playing the bull or bear game.